The Accunet Mortgage and Realty Show is sponsored by Accunet Mortgage, an equal housing lender, NMLS ID 255368, and Accunet Realty Advisors, which is a separate company from but still affiliated with Accunet Mortgage.
Putting a roof over your head without the headache. Get answers to all of your home buying questions. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
And our Sunday best to you. Good morning and welcome to the Accunet Mortgage and Realty Show. I'm Steve Kettlear, along with Accunet Mortgage and Accunet Realty Advisors owner and president Brian Wickert and licensed millennial loan consultant David Wickert. As always, if you have a question, you can give us a call at 414-799-1620 or throughout the Midwest on the Accunet Mortgage toll-free talk line. That number's 1-800-877-1620. So we've had some interesting reports this past week and then also coming up this week that are going to impact mortgage rates, aren't they?
Yes, we really had the treasure trove here in this little short 2-week period. And what I want everybody to keep in mind as we talk about these topics today are two big concepts. Number one, inflation is the enemy of interest rates. Because if prices are going up at 2% per year and you've got your money invested in a 10-year government bond at 2%, you are making 0%. Okay, so that's why inflation is the enemy of interest rates. The number two thing is that the better the U.S. economy does, the greater the chance of inflation. So one of the things that determines how well the economy does is employment. And guess what we have coming up this Friday? The monthly employment report. Okay,
yeah.
The first Friday of every month. So we're all going to be looking at that. The forecast is for 175,000 new jobs. Well, you back up a few days. On Wednesday, we got the Federal Reserve Open Market Committee meeting. Nobody on the planet expects them to change rates on Wednesday. But everybody on the planet in the financial markets will be looking at the words in their statement and clues for when they're going to, raise rates next day. But what are the odds for the next rate?
I was just going to say, not nobody. 4% of the market thinks they might raise rates on Wednesday.
Okay.
4%.
Right, 4%.
But generally, it's holding off until about May is when about 36% of people think they will. But then June, July is when we get to a majority of people think they might raise rates.
One of the big inputs that the Fed looks at, in addition to job growth, is inflation. They use not the CPI, the Consumer Price Index. They don't look at that. They look at something called the PCE, I forgot what that stands for. I'll let you know in a little while. The Personal Consumption Expenditure Index, that's what it is. And they want that to be at 2%. So to the extent that comes in on Monday at or above 2%, that'll add fuel to the fire for the future rate increase. Okay, so we've got all that coming up. What we found out on Friday, though, is that the gross domestic product, that's the sum total of all the goods and services that get sold in America, minus the cost to produce them, that came in at 1.9% for the last 3 months of 2016. And if you compare that to the previous quarter, where it was 3.5%, which is really good. It's like,
huge.
Wow. Yeah, that's a big drop-off. Now that we have the last quarter of 2016, we can also compare it to the previous year. In 2015, the economy grew at 2.6%. Not bad. But for all of 2016, 1.6%. Still, and David and I were talking about this before the show, we are on a 90-month-long expansion of the economy. So,
good job by us.
Yeah, that's good. Even though it's been tepid,
okay,
right? Because you can't really write home and brag about 1.6%. The other expansion since World War II, 92 months long. We're going to beat that one, pretty sure. That happened in the Reagan and Bush administration 1992 to 1990. We'll have to go all through 2017 and 18 to catch up with the 106-month-long expansion that occurred during the Vietnam War from 1961 to 69. See, we're just trying to give you a cocktail conversation, Steve, for the rest of it.
Of course.
But the granddaddy, it turns out, is a 10-year economic expansion from March of 1991 to March of 2001 during the Clinton administration. Also gave us the dot-com bubble. So we got a long ways to go before we catch up with that 10-year record. All right, the other thing that, just again, trying to make people well-rounded citizens here of the United States of America. The economy in 2016 amounted to a whopping $18.5 trillion with a T dollars worth of goods and services. David, can you remind us, please, of what is a trillion?
Well, so to try to, and not to, make everyone feel the hurt from last weekend, but a Super Bowl ad this year is going to run north of $5 million. You could buy a Super Bowl ad every hour, and it would still take you 23 years to blow through $1 trillion.
Wow.
Wow.
That's a lot of money.
That's a lot of ads.
And the one that I did is if you bought a $25,000 car every day, okay, so you go out and buy a new car every day.
Yeah.
It would take you 109,000 years.
Yes.
So back to prior to the dawn of humanity to run through $1 trillion. So that's a lot of money. Okay, a couple of other quick things here. Here's how it breaks down, and this is why consumers are so important. Consumer expenditures account for 69% of our economy. 69% are what you and me and all of our listeners spend money on.
Yes.
Gross domestic investment. Oh, by the way, consumer confidence was at a 13-year high in one measurement. I think it was the University of Michigan Consumer Sentiment Index came out on Friday.
People are feeling good.
Very optimistic, okay? Then you got domestic spending, so things we invest in. You know, cars would count for that and so on. That's only 16%. Government spending is only 18%. And then you subtract out net exports, that is $500 billion. That's nothing. All right, when we come back from this first break, I just want to quickly, before we move on to some of our other topics like refi-phobia and news from the front lines of mortgage lending, I'm going to give you, Steve, a quiz, and also David, on which parts of the U.S. economy contribute the most to the total when we come back.
All right, I'm going to get my number 2 Dixon Ticonderoga ready to go here on the Accunet Mortgage and Realty Show on WTMJ.
Don't break the bank to get into a house. Back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, new research shows that people who crack jokes at work aren't just the most well-liked, but also some of the most respected in the office. What are some of the dangers, though, of being the office jokester? Get the whole story on Wisconsin's Afternoon News at 3:34 tomorrow here on WTMJ. All right, we're up to the quiz portion of the Accunet Mortgage and Realty Hour.
That's right, and you can play along at home. We're talking United States economy for 500 here, and we're looking at the stats for the U.S. economy in 2016. It's an $18.5 trillion economy, the biggest on the planet. And so I've got 5 questions cooked up. Are you ready, Steve and David? We're going to go head-to-head here.
I want the record to show I did not cheat before this, so
okay,
I'm
good.
coming at this blind.
All right, so question number 1. Which part of the economy contributes more than the other? Is it motor vehicles and parts or furnishings and durable household equipment? That would include washers, dryers, TVs, kitchen appliances. So motor vehicles, Steve, or furnishings and household equipment?
Furnishing household.
David?
I'm taking cars.
All right, David's the winner on this first score. Boom. It's $474 billion for motor vehicles and only $317 billion for kitchen appliances.
Wow, okay.
Only.
All right, so we're going to now put motor vehicles, you already know what that answer is, $474 billion, up against food and beverages purchased for off-premise consumption. In other words, groceries. Stuff you buy to eat at home. Which one's bigger?
Oh, that's going to be more.
I'm still taking cars.
Cars, Steve?
I'm taking food.
Groceries? Food. Food. Ding, ding, ding. We should have another sound effect, Ben, for next week.
Sure.
Yeah. That's $916 billion. So,
wow.
Really,
in groceries.
Almost double groceries versus cars. Now, we're going to put groceries at $916 billion up against financial services and insurance. Steve, you were the last correct answer, so you go first.
All right.
Groceries or financial services? Which is bigger?
Financial services.
Dave?
Is this before or after the fiduciary rule?
Financial services.
I'm going to still take groceries.
All right. Steve's pulling ahead here because financial services eke out groceries. They're $958 billion.
Wow.
All right. So financial services slightly better than groceries. Now we're going to pit financial services against health care.
Healthcare, hands down.
God, yeah,
One out of every $7 is healthcare.
All right, Steve, you're on healthcare too?
Yeah, for sure.
Okay, yeah. It's double, more than double. Healthcare is $2.2 trillion, or 1 out of every $8 in our economy goes towards healthcare. Think about that. Wow. All right, last one. So what's the score, Dave? 2-2?
Steve's got me 3-2.
3-2. You guys want to double down on this one? Double or nothing?
Yes. Do I have to answer in the form of a question?
No. All right, so this is worth 2 points. All right, is it healthcare at $2.2 trillion or housing and utilities? Housing
Healthcare.
and utilities. Healthcare, says Steve.
I'm going to say housing because I'm in the mortgage business.
And David ekes it out for the tie.
Wow, David!
Yeah. I think it's because of the utilities. The utilities had to tip it over. Okay. Utilities is $2.3 trillion. Wow. All right, there you have it. By the way, one other little nugget. In the government consumption area, which was, you'll recall, a mere $3.2 trillion, this will be just kind of for fun of it. Which is bigger, state and local or federal?
Federal.
Dave says federal. Steve?
Federal, yeah.
You guys are wrong, because all the schools and stuff are in local.
Oh.
It's $2 trillion for local government and $1.2 trillion for federal. All right, there you go. All right, so thanks for playing, guys. When we come back, I've got a story from the front lines of mortgage lending. This is our out-of-state lenders who had to write their offer to purchase without a financing contingency. I'll give you the update on that when we come back.
Right here on the Accunet Mortgage and Realty Show on WTMJ.
Home buying advice from the guys who know it best. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, WTMJ's Gene Miller says there are 2 seasons in Wisconsin, Packers season and Packers fans season of discontent. So are we just waiting for the start of the next season now? You can read more of Gene's thoughts right now at WTMJ.com. Brian Wickert and David Wickert are with us as we are working our way through the Accunet Mortgage and Realty Hour. So we're focusing in on an out-of-state buyer situation.
Yeah, and this one is somewhat unusual. You may or may not know we talked about this situation before, but I don't think I tied the ribbon to this element of it. In Wisconsin, when you do new construction, typically 9 out of 10 homeowners have to get a construction loan. They have to finance the construction of the property themselves. Well, in most other states, including this state, it's Florida, where these folks are buying new construction, the builder finances the construction, and then the homeowner just buys the house when it's done. Okay? So this transaction started in September when they signed the contract and we got their application going. And the house isn't going to be done here till the end of February. Well, the builder refused to allow these buyers to have a financing contingency. And just to remind you, a financing contingency is a get-out-of-jail card where if you can't get your mortgage approved by a certain date, then you can back out of the contract, get your earnest money back, and be on your merry way. So the builder's like, I'm not having any of that. And they had to put a rather large down payment. I want to say they have put – this
you
is
mean
typical.
earnest money?
Well, earnest money is exactly what I mean. I think it's 10% of the purchase price, which is, like –
well, so but is to say if they can't deliver, the builder's going to keep their money and then go probably sell the house to somebody else.
$45,000.
Whoa.
Okay. So here we are. Now we're well into this process. We have the house appraised. We have the borrowers approved, great credit, great stable jobs. But then I get a call this week. One of them got laid off last week.
Oh, yikes.
Whoa. So we got a month to go. Now half their income for this purchase is gone. And they're notably concerned, but the guy had already been, working on some other job possibilities.
Okay.
But the solution turns out to be this, and we do this fairly frequently. I quickly looked at the numbers while they were on the phone, and it turns out that the person who lost their job also had a lot of student loan debt. So on a normal loan, a Fannie Mae type loan, which this is, if we eliminate a borrower, we also get to eliminate their debt. And so just by the luck of the Irish, when we eliminate the borrower who lost his job and his debts, the other person, debt-to-income ratio, 44%. And what's the maximum? 45%. Yep.
Wow.
So we are going to remove the borrower who just lost his job, and therefore remove his debts. And now, go ahead, Dave.
Well, I had an example of this last year of a husband and wife. Wife just graduated from medical school and had, let's say, $200,000 worth of student debt. And so by leaving her off and just having the husband qualify, her income in the future will be substantial. But right now, she's just making $50,000, but it's, it'll go up in the future. It's that kind of that splitting the difference where it's like, in your example, he's going to find another job. He will contribute to making ends meet in the household, but from the conservative kind of viewpoint we have to take on qualifying, hey, we'll remove him and his student loans, and that makes the math go.
And that makes it go. Now, the other thing I wanted to point out, though, is that, so this is unusual because they had no financing contingency date. Every home buyer is actually at risk for this. I just wanted to point out. For the small period of time, typically between the date that they give the seller their loan commitment, hey, I got my loan approved, and the date of closing. They're at risk of, if they lose their job, they've already handed in their red flag to say, I can throw this if I can't get my loan, because you just said I got my loan.
So you're saying, why not put 3 or 5 days after you deliver that, put the closing date?
Yeah. So if you're a buyer, you would like to have the financing contingency date as close as possible to the closing date.
Yeah.
Sometimes we find it's really weird in Minnesota. It's the same day. There is no financing contingency date. Anyway, so that's the story of how we were able to save that deal. And, that's why a financing contingency is important protection for home buyers. All right, when we come back after the news, we're going to talk about, because we really haven't ever talked about it much before, is Accunet Mortgage's really cool mobile app for home buyers when we come back after the news.
Right here on the Accunet Mortgage and Realty Hour on 620 WTMJ. It's now 10:30. As we welcome in from the WTMJ 24-hour newsroom, Colleen Boland.
Thank you, Steve. The U.S. military says one...
Expert advice on buying a home. Here's more of the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert and David Wickert are with us here on the Accunet Mortgage and Realty Show. So I'm looking at the Accunet mobile app right now on my iPhone, and I bought 5-6 homes over the years. I wish I would have had this the last time I was going through a house and going, okay, what are the real numbers?
Correct. And so I came to that realization like 2 years ago when I was helping our daughter and son-in-law shop for their house, and she would always ask me, because, I have my broker's license, but I only have worked with family members. But I'm literally like showing them houses, okay, and she would turn to me and say, okay, Dad, what would my mortgage payment be on this? And I'd go like, I don't know.
I don't know. What do you think? I work in the mortgage business?
I can't do that. So on our web app, if you go down to in the bottom, you see the little thing that says calculator. I think this is the coolest thing for home shoppers. And then we have 3 calculators: purchase calculator, refi calculator, and affordability calculator. If you click on that purchase calculator, Steve, all you have to do is fill in the purchase price, what percent are you going to put down, an interest rate, like, right now I put in 4.25 for a 30-year, and then you simply fill in the property taxes per year, homeowner's insurance, and if you're buying a condo, the condo dues.
Yeah.
Most importantly, then it asks you your credit score, because the answer it gives you back, if this is really cool, if you're putting less than 20% down, includes not just the principal and interest, but also the taxes, also the homeowner's insurance, and the cost of monthly mortgage insurance according to your credit score.
Yes.
So if you know your credit score, which you should know if you've gone through the pre-approval process with Accunet, you could be standing in that house and figuring out, oh, okay, this is how much my payment is.
Because that's the question. If you're standing in a house later this afternoon, you're going to turn to your significant other and say, honey, what would the monthly payment be on this house, and do we want to afford that monthly payment?
Right. And what a lot of home shoppers forget about is property taxes. Well, and the mortgage insurance, frankly.
Yeah.
So then if you click on the calculate button, you get a cool pie chart. But the most important thing is it tells you your monthly payment. The other cool thing that you can do if you hit the home button there in the lower left-hand corner is you can see what today's rates are. Boom. You could also get started on a rock-solid pre-approval right from your phone. There is a calculator on there that I want to dissuade you from using, but you could to get started. It's your own affordability calculator. You can try to self-diagnose how much home can I afford, but I really encourage everybody to, okay, if you want to start with that, fine, but you really got to talk to a licensed loan consultant at Accunet or somewhere to get a little better diagnosis for that. And I'll tell you the number one thing that consumers do not know, and David mentioned the two words student loan in the last segment that we did. We find, I think, that most first-time home buyers who have student loans are on the income-based repayment plan, which means they're not even making a payment large enough to cover the interest due. They're, in other words, piling up interest on top of interest and principal on their student loans. We cannot use that income-based loan payment to qualify. David, what do we have to do?
We have to use 1% of the outstanding balance. So if you have $20,000 in student loans and your income-based payment is $50, well, we have to do the calculation so that when you start paying on that loan, it doesn't blow up your budget. We get to use 1% of that balance. So on $20,000, that's a $200 a month payment.
Not the $50.
Correct.
So, if you're doing these self-diagnosis calculators, you're going to come up with an artificially low monthly payment. Now, the other thing that's true about the calculator we have on our app, because I'll confess, we didn't build the app, we bought it.
Yeah.
They use a 36% debt-to-income ratio, meaning that if you make $10,000 a month, the total of all your monthly debts, including your car payment, your student loans, your principal, interest, taxes, and insurance, can only add up to $3,600 or 36% of that $10,000 monthly income. Well, we said in an earlier segment, we can run that all the way up to 45%, very typically.
Yes.
So just another good reason to put yourself in the hands of a loan consultant. And I should also mention the National Association of Realtors just came out with their year-end report and stated that housing inventory is at an all-time historic low. Okay, since they started keeping track of these numbers, there are fewer homes for sale right now, and we hear that anecdotally from real estate agents. All the more reason why you want to get a rock-solid, guaranteed pre-approval to put yourself in the absolute best light when you're out there shopping for a house. All right, so there you go. That's the dime tour, the nickel tour of the Accunet mobile app. You can get it for Droids or iPhones, either one. If you're on your phone, you just go to Accunet.com and click on the green button to download the app. It's free, and it's really cool. Anywhere, anytime you want. All right, when we come back, David, let's do a little rate roundup and also talk about refi-phobia when we come back.
Right here on the Accunet Mortgage and Realty Show on 620 WTMJ.
Getting you through the home buying process. Welcome back to the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Well, he's the pride of Waukesha, and you probably know him for doing every other voice than his own. But now Frank Caliendo wants to move away from stand-up comedy and into acting. He looks ahead to future projects with Gene Miller during today's Conversations show coming up at 11:07 this morning right here on WTMJ. So we've got a rate roundup, and then maybe we can diagnose refi-phobia.
You bet. So I still miss the Copeland hoedown music that you used to play years ago. Anyway,
all right, we can get that back. All we got to do is ask.
All right, so at Accunet, at the close of business on Friday with 25% equity and all the other... Thanks, Ben. I appreciate that. With all the other right stuff, including escrowing for taxes, no second mortgage or line of credit, Accunet could still deliver 3.99% on a 30-year fixed-rate mortgage. You would have to pay 0.8 of a point in order to get there. The APR is 4.091, and that'd be about $2,700 in cost.
Okay.
So if you want the trophy rate that starts with a 3, totally fine. But if you want regular closing costs, 4.125% on a 30-year, APR is 4.16. And then if you're like me and you like it when other people buy you dinner, I would take the no closing cost option at 4.25%, and the APR is the same.
Okay, and what are our regular closing costs?
Regular closing costs, $1,100. The things, I always say this, the things that have to get done, no matter who is buying or refinancing a home. So there's no paper shuffling fee, underwriting fee, Super Bowl ad fee.
Right.
It's literally the appraisal, credit report, title insurance, and the closing agent, the person who helps you sign your name. That's it.
Yep. Okay. So yeah, that's a lot less than your other lenders out there.
Yes.
At least 1,000. Okay. Go
At
on.
least. Well, so the other thing that's been interesting since this summer has been the widening spread between a 30-year fixed and an ARM product, an adjustable.
What? I haven't said ARM on the radio since, I don't know.
In a long time.
So
the adjustable rate mortgage is where the rate is fixed for the first X number of years. That can be anywhere from 5, 7, or 10 years. It is amortized over 30, so you'll pay it back.
Yep.
But for those people who think, like, you know what, I work for XYZ big corporation, and I don't think I'm going to be here in 5 years.
Mm-hmm.
Maybe it's more worth it to do an adjustable rate mortgage.
And what is the rate, pray tell, on a 7-year?
So on a 7-year ARM, just as an example, is 3.625%. APR is 3.86.
Okay. Is that because the closing costs are so high?
No. It's the exact same. It's a 0.5% lower than a 30-year.
Right.
And lenders are trying to incentivize getting to that ARM product over the 30. I'm not saying it's right. The difference in the payment is $57 a month,
which, over 7 years adds up. It's so mainly for the person who knows they're not going to be there.
Right.
All right.
So that's
maybe that spread will continue to widen.
Yeah.
What else? You got anything else? 15-year fix?
Yeah. Let me come back to you on that. Start talking about your refi-phobia.
All right. Refi-phobia. So I was running a 60-second ad this past week on refi-phobia, and I was talking to my brother yesterday. He said, "Oh, I like that ad." So the symptoms of refi-phobia are several. I came up with 5. One is, the rate's just not low enough. I heard from my grandpappy that it had to come down 1% before it made sense to refi. That's not true. It depends on your loan size. The new rule of thumb is the rate's got to come down 0.5% typically on a $200,000 loan to make a payment reduction refi worthwhile. But some of the more popular motivations right now for refinancing are shortening the term.
Yes. Like
maybe you got 20 years left, you can get down to a 15-year.
15-year at the end of business, 3.375%. Regular cost, APR is 3.43.
Okay, so, maybe you're sitting there. I was surprised last week, Steve, when we had the caller with the roof remodel, because that's another roof replacement, I should say. That's another motivation that we're seeing right now is taking cash out to make some improvement in the home, kitchen remodel, repair the roof. She was sitting there at a rate of 4.25%. I'm thinking, wow, why didn't you refinance earlier? But she obviously didn't. And so taking cash out to either consolidate a home equity line of credit is another good motivation. All right, so number two symptom of refi-phobia, it's going to be too much hassle. Well, we can take care of that. Why? Because we got e-sign. Typically, all we need is a pay stub and a W-2. We'll even send the closer to your house. Symptom number 3, I don't want to start over again. I'm 6 years into my 30-year fix. I don't want to go back to 30 years.
No problem.
We can customize your loan term, the number of years, to any number of years you want between 10 and 30. Number 4 symptom, it's going to cost too much. Well, David just told you we've got the whole menu.
Like the no closing cost
you
option.
Can spend, or we can pay it for you. And finally, we've got the I'm afraid my house isn't going to appraise out. Well, we just came out this year with Accunet's exclusive no-risk refi, where if we come up with a reasonable value for your home, like looking at the tax bill or maybe a automated valuation model and going, but you're still scared to do the appraisal, no problem. We will take the risk and the cost of the appraisal deposit, and what we're going to do is have a desk appraisal done by a real local appraiser. Going to come up with a value, and if it's okay, then we'll proceed with the full appraisal, all with no appraisal deposit required. That's our no risk refi. All right, what are we going to talk about
when we come back? You touched on it, but I want to talk about inventory and what that means in getting a rock solid pre-approval to go buy a house here.
And I have an example of somebody with 5% down who we helped just this past week. When we come back.
And if you have a question, you can call us here on the Accunet Mortgage and Realty Show at 414-799-1620. Or throughout the Midwest, toll-free on the Accunet Mortgage toll-free talk line. That number is 1-800-877-1620.
Important home buying questions and answers you can count on. This is the Accunet Mortgage and Realty Show with Brian Wickert on 620 WTMJ.
Brian Wickert and David Wickert are with us here on WTMJ this morning.
So we talked about a little earlier in the show how there is a severe lack of inventory, and yet We are cranking out the rock-solid guaranteed pre-approvals. Remember, our outstanding feature is that we not only verify credit, that's what banks do, we also verify income and assets. And on top of that, though, we put a big page with huge type that says we're giving a $2,000 guarantee. That's
putting our money where our mouth is.
Absolutely. If we can't make good on our rock-solid pre-approval, we're telling the seller we'll write them a check for $1,000, and we'll also write a check for $1,000 to the buyer to say, boy, we're sorry we made a mistake. Well, we haven't had to write any of those checks because we're really thorough, but we're really trying to back it up. Well, I had some buyers get an accepted offer this week, even though they're putting 5% down, and the competing offer that they were against was putting 20% down. Bam. Because usually when you're a seller looking at competing offers, the first thing you look at and say, do either of these offers, do they have to sell their existing home? Because that's the real kiss of death. Like, man, I don't want to be dependent on that. And then the next thing they look at is price, and then maybe the next thing they look at is how much down are they putting?
What is the strength of their ability to
what's
buy?
the strength, right? Because 20% down generally is better than 5%. But what we're really doing is helping those lower down payment borrowers get on the same footing as competing offers that have a bigger down payment, because people are recognizing that the rock-solid little cool emblem that we made and the $2,000 guarantee really means something. What were you going to say about that, David?
I was just going to note that this is especially true for not just first-time home buyers, but even retirees.
Okay.
In trying to line up, it's a different flavor if you're trying to qualify off of Social Security or pension income, or even we can do IRA distributions, and to line up that strategy ahead of time to reduce the stress of, can I buy a house if I'm not working full-time anymore? It applies, I have said, not just to first-time, but also fifth-time and 10th-time home buyers.
Okay, so I'm going to point out another example of that is when the person buying the home is not selling their other home first. Okay, so they're writing the offer, and they happen to be existing home buyers, but they would like to write it without a sale of home contingency. Our rock-solid pre-approval has a line in it that we highlight, underline, and put yellow on that says this pre-approval letter does not depend on the sale of this person's existing home. So it can, not just for first-time buyers. We're giving confidence to the seller that this deal's really going to happen. We've really checked out all the angles. Sometimes people need to have bridge loans. That's temporary financing to help extract the equity from their old home so that they have the down payment on the new home. We know how to make that happen as well. And we have other clever ways to structure things. We won't go into it in this particular segment, but we can help people end up with the financing on their new home just the way they like it.
I think just to go a little macro here, and it's going to apply not just to this home buying season, but probably 2018 and 2019, is as a country, we are making 1.7 million new households, people moving out of their parents' basement.
Okay.
And we're only building 1.2 million new places to live.
Oh, good point.
That is the classic definition of supply and demand. And so if you're writing an offer in Wauwatosa this summer, and there are 3 other offers.
Or this February,
you have to be the most attractive version of yourself before you're walking through the house on Sunday afternoon wondering, do I want to have Thanksgiving here?
Sure. So you got upward pressure on prices. The other thing that's a factor is, we refinanced so many people at 3.5% on a 30-year fixed. That's kind of hard to give up, when rates are now at 4.125. You have to have a little stronger motivation. It's not like the other way where, hey, my old rate on my existing house is 4.25, and I can buy a new one at 3.5. That's going to help push me to sell my existing home. So I guess the message here is that if you have a home that you're thinking of selling, get it on the market right now, because
now if not sooner.
We are issuing lots of rock-solid pre-approvals to buyers.
There are hungry buyers out there.
There are more buyers than sellers right now, so now's the time to get out there. All right, so to wrap up the themes from this week's show, we've got a treasure trove of economic data coming out this coming week. We got the Federal Reserve meeting on Wednesday, pretty much a non-event. The Big Daddy event is on Friday.
Jobs report.
Rates have been kind of volatile. We ended up this week okay, but it was a bumpy ride
during
the week. So it's still a good time if you're thinking about paying off that adjustable rate home equity line of credit, which is going to do nothing but going up. David pointed out off the air, nobody is talking about the Fed decreasing rates this year. It's just a matter of how many times they're going to go up. So it's plenty of time, good time this week to click on the blue button, either for that refi checkup or to get started on your rock-solid, guaranteed pre-approval to buy. We'll see you here same time next week, Steve. Thanks a lot.
You've been listening to the Accunet Mortgage and Realty Show on WTMJ. Colleen Bolin joins us from the WTMJ 24-hour newsroom next.
The preceding was a paid program. Advice and opinions expressed during the Accunet Mortgage and Realty Show are solely that of the hosts or guests of Accunet Mortgage and Accunet Realty Advisors and not WTMJ Radio or Scripps Media Incorporated.